Hi there. Today we'll explain how the shareholding exemption works when selling trading subsidiaries, and why understanding the rules is essential.
Imagine building a trading subsidiary from the ground up, scaling its operations, and successfully executing a £10 million exit. Looking at this ledger, you expect tax-free proceeds. Instead, an oversight triggers a £2.5 million tax demand from HMRC. This exact scenario played out in M Group Holdings. The directors formed the subsidiary 11 months prior to sale. That 1-month discrepancy cost the entire exemption. I am a senior consultant with Pro Tax Accountant. To navigate the highly scrutinized 2026 UK corporate tax landscape, you have to understand the precise mechanics of corporate restructurings before you sign a term sheet. The mechanism that allows a company to sell a trading subsidiary tax-free is the Substantial Shareholdings Exemption, codified under Schedule 7AC of the Taxation of Chargeable Gains Act 1992. As the timeline of this legislation shows, these rules have been evolving for a decade. The exemption is earned through prior conduct. The conditions are governed by facts that must exist for a continuous period before a sale ever happens. Failing to build this structure properly turns a lucrative exit into an irreversible tax liability. And under the strict new rules enacted for the 2026 tax year, the margin for error dropped to 0. This diagram outlines the first mandatory rule. The investing parent company must hold a minimum of 10% of the investee subsidiary. That absolute threshold applies equally to ordinary share capital, entitlement to distributable profits, and assets available upon winding up. Next is the temporal rule. This 10% holding must remain intact for a continuous block of exactly 12 months. The legislation provides a specific relief valve. That 12-month block does not have to be the year immediately preceding the sale. It can occur anywhere within a 6-year look-back window prior to disposal. Following corporate tax reforms enacted in 2017, the rules regarding the parent company were relaxed. The investing parent is no longer required to be a trading company itself. This means pure, passive holding companies are entirely valid vehicles for securing the exemption. You can hold shares, execute a tax-free disposal, and reinvest the proceeds globally. The strictness applies to the target. The investee subsidiary being sold absolutely must be a trading company throughout the relevant qualifying period. This creates a hidden trap for highly successful businesses. Directors often leave excess cash reserves or investment properties sitting inside their primary trading entities. HMRC does not define a trading company by its primary label. They assess the entity's activities in the round, actively penalizing companies that accumulate substantial non-trading wealth. This dashboard represents the 4 indicators HMRC evaluates: the level of non-trading income, the value of the non-trading asset base, staff time managing investments, and the company's historical context. The mathematical threshold is rigid. If an analysis reveals non-trading activities exceeding 20, the legislation specifically targeted and tightened Section 137 of the Taxation of Chargeable Gains Act 1992. Previously, companies could execute pre-sale restructurings and share exchanges without immediate tax consequences, provided they could demonstrate bona fide commercial reasons for the broader deal. For any share or debenture issues executed on or after November 26, 2025, that commercial reasons defense has been entirely removed from the statute. The new test is ruthlessly objective. If any subarrangement within the restructuring has the main purpose of reducing a tax liability, HMRC will disallow the relief. The net has also been whitened. The previous carve-out that protected minority shareholders holding 5% or less of a company has been removed. To safely extract a trading division for sale without violating these new rules, companies rely on the statutory hive-down mechanism. When a trading asset is transferred to a new subsidiary within the same group, the parent's historical trading time legally attaches to the new entity, bypassing the need to wait a full 12 months. While hive-downs are explicitly permitted, any error in the structural sequence will trigger the new Section 137 anti-avoidance tests. In this environment, relying on assumptions is reckless. Securing non-statutory pre-transaction clearance from HMRC is a mandatory survival tactic for any complex restructure. Under the 2026 rules, simple paper-for-paper exchanges no longer grant automatic deferral. each step must now satisfy a rigorous purpose test. The contrast is clear. A reactionary restructure on the eve of a sale invites tax failure. A preemptive, compliant holding structure executed 12 months in advance secures the capital. Despite the intense scrutiny introduced by new anti-avoidance rules, the substantial shareholdings exemption remains the ultimate mechanism to extract capital tax-free from a UK business. Structurally, it's an automatic exemption. You do not formally apply for it before the sale occurs. The responsibility lies entirely on your company to self-assess the transaction and claim the exemption when filing the CT 600 corporation tax return. Self-assessment shifts the entire burden of proof onto the directors. Your documentation must be flawless and audit-ready from day one. You must possess concrete evidence of the 10% ownership threshold, the strict continuous 12-month timeline, and the financial data proving your non-trading activities never breached the 20. If you are a UK director preparing to sell a trading subsidiary, restructure a corporate group, or establish a holding company for a future exit, do not leave your corporate architecture to chance or rely on advice predating the 2026 legislation. Pro-Tax Accountant provides the specialized authority required to safely navigate Schedule 7AC and pass the new Section 137 purpose tests. Contact our expert tax advisory team directly using the details on screen. Visit our website to book a bespoke consultation and ensure your corporate structure is fully compliant before you proceed with a transaction. Finally, subscribe to our channel to stay ahead of the latest high-level UK tax strategies.